You open your banking app. The number is right there. $2,040. It feels like a fact. Solid. Yours. It feels like a pile of cash in a drawer somewhere, with your name taped to the front. It isn't. There is no drawer. There is no pile. There's just a number on a screen and a company's promise to honor it. Here's the strange part. Right now, American banks hold about $18 trillion in deposits. But most of that money is not actually in the banks. It's already gone. Lent out. Spent. Turned into someone else's mortgage, someone else's car, someone else's small business. The bank keeps only a thin slice on hand. The rest is out walking around town. So it's worth asking one simple thing. The money in your account, who actually owns it? The moment you deposit money, something quiet happens. Legally, the bank owns it now, not you. What you own is a promise, an IOU. The bank owes you that amount and agrees to hand it back when you ask. Your balance isn't cash sitting in a vault. It's a single line in the bank's ledger that says, "We owe this person." Picture your dollar walking down to the vault to visit itself. It opens the door. The vault is empty. Its money already caught a bus across town to become a stranger's car loan. You've actually felt this, even if you never named it. Ever deposit a check and watch it sit there, pending, for 3 days? That little hold is the system quietly reminding you, this isn't yours to grab yet. You're waiting on a promise. This has a name. Fractional reserve banking. And it isn't a scandal. It's how banks have worked for centuries. Take the deposits, keep a little, lend out the rest, earn interest on money that isn't really there. It works. Quietly, reliably, right up until everyone asks for their money on the same day. March 2023, Silicon Valley Bank. In a single day, customers tried to pull out $42 billion. The bank didn't have it on hand. Almost no bank ever does. Within 2 days, it was gone. At the time, the second largest bank failure in American history. Thousands of people sat refreshing an app, staring at a number they suddenly could not touch. Now, you're probably thinking, but my money is insured. And it is. Sort of. The FDIC covers up to $250,000 per depositor. If your bank fails, you'll most likely be made whole. Eventually. But look closely at what that promise admits. You need insurance precisely because the money was never just sitting there, waiting for you. You aren't the owner holding your cash. You're a creditor, standing in line, hoping the promise holds. So picture a different version. You hold your money yourself, not a promise from a bank. The actual asset, in a wallet only you control. No one lends it out behind your back while you sleep. It's simply yours, the way the cash in your pocket is yours. And the reserves? Instead of trusting a statement once a month, anyone can check a public ledger, live, and confirm the money is really there. It's called proof of reserves. Every coin out in the open, countable by a stranger at 3 a.m, the vault gets a glass wall. You don't have to take their word for it anymore. You can just look. But be honest about the trade. Holding your own money means holding your own risk. Lose the keys and there's no branch to call. No one to reverse it. No one to blame but the mirror. The bank's promise was also a safety net. A person on the other end who could fix a mistake. Self-custody hands you the controls and the consequences, both at once. That's the real choice underneath all of this. Convenience or ownership? So here's where it lands. The bank's version, you have a number and their word. The other version, you have the money and the proof. One asks you to trust, the other lets you check. Either way, it's worth knowing which one you're actually holding. If you want more of these, subscribe.